Short exercise 5-6. We're going to have a sales transaction on account, and we offer a discount, but this time the customer pays us past the discount period, so they do not actually get to take the discount. So journalize the following sales transactions for Henry's Craft Shop. Explanations are not required. Assume the company uses a perpetual inventory system and records sales at the net amount. So remember, the new revenue recognition standards say that when we record a sale with a discount, we have to assume that the customer is going to take the discount, so we record it after the discount. So on February 3rd, Henry sold $4,000 of craft supplies on account. Credit terms are 210 net 30. So the customer will save 2% if they pay within 10 days. Otherwise, the net amount is due within 30 days. And we sold it to Quick Quilts. Cost of goods sold is $1,200. So we sold crafting supplies that cost us $1,200 for $4,000. Wow, huge markup. So let me move this up here. Begin by preparing the entry to journalize the sale portion. All right, do not record the expense, so we'll record the cost of goods sold in the second transaction. So we have to calculate how much are we going to list the revenue and AR at. So the way we do that is we're going to take the 4,000 times 0.02, because they're going to save a 2%. They're going to save 2% if they pay within 10 days. So they will save $80. So 4,000 minus 80. So 4,000 minus 80 equals 39.20. So we're going to record the AR. Oops, I hit the wrong button. 39.20 was the number. 39.20. So now, what is the debit account going to be? Well, when we sell something, we're either going to get cash or we're going to record AR. And since we sold it on account, we have to increase AR. AR is an asset, so how does AR increase? With a debit. So AR is going up. And then the other account is sales revenue. Our sales are going up. How do revenues go up? They go up with a credit. So that is why I am crediting sales revenue. Next, now journalize the expense related to the February 3rd sale. So cost of goods sold is $1,200. $1,200. So I always like to start off with the one that's easier to understand, inventory. So inventory is an asset, and when we sell the inventory asset, the inventory asset is going down. So inventory goes down with a credit. So I have to credit merchandise inventory. And whenever we sell a product, we're going to transfer it from that inventory account and move it over to the expense account called cost of goods sold. So again, it's leaving the inventory account and we're moving that cost into cost of goods sold. So this cost of goods sold is an expense and it's increasing. How does it increase? With a debit. So COGS will be the debit. Finally, Henry received payment from Quick Quilts on the amount due. Now let's see if they get the discount. So they bought it on February 3rd up here, and they need to pay it within 10 days. But it is now 20 days later because it's February 23rd, so they do not get the discount. All right. So they have to pay us the full amount of $4,000. But here's how I like to do this. I like to start with, let's start with cash. Cash is the easiest to understand. Because they don't get the discount, they're going to pay us $4,000. So cash goes up, $4,000. Why am I debiting cash? Because cash is an asset and assets go up with a debit. All right. Now what happens to AR? Well, once they pay us off, even though they're paying us $4,000, we need to get rid of the full amount of AR. So let me put this in a T account. So here's AR. If we sold back on February 23rd, or February 3rd, I should say, we sold, so our AR went up $39.20. Now, when they pay us off, we have to make the balance zero because they will no longer owe us anything. So how do I make this account zero? I need to credit the account $39.20. So AR is going to be credited $39.20, $39.20. Now notice this transaction does not balance. We got 4,000 on the left side, 39.20 on the right side. So to calculate the balancing amount, we take 4,000 minus 39.20. That gives us $80. So we have to put the $80 on the smaller side because remember, debits must equal the credits. So what account is this? So really this $80 represents that 2% discount. And in this case, they gave up the discount. So what account do we use when a customer gives up a discount? We use the account called Sales Discounts Forfeited. Forfeited means give up. Like if you forfeit a basketball game, that means you give up and the other team wins automatically. So this could be called Sales Discounts Given Up. So we increase it when the customer does not pay in time to get the discount. And it represents the discounts given up or forfeited by the customers. So we're going to credit that account. And remember, the sales discount forfeited is a revenue account. Sales discount forfeited. So our total revenue for the account is a $39.20 plus $80. And that's it.